Well, good afternoon to our European audience, and also good morning to US listeners, and welcome to this last edition of Trend Watch in 2022, where we will discuss investment perspective going into 2023. First, let me introduce the speakers. Today, we have the pleasure to have Rosie Bullard, partner and portfolio manager at James Hambro and Partner. We have also Ulrika Haasselgren, who is the Chief Sustainable Officer at Coeli AB. And finally, we have Antoine Denis, who is the Head of Investment Advisory at Bank Cis. For the audience, as on your Zoom screen, there is a Q&A tab at the bottom. And so if you want to enter any of the questions during the panel, you are more than welcome to do so. I will start the discussion by a few questions, and then we'll get back into the Q&A audience afterwards. So potentially to start the discussion today, the first topic, which I think is not a big surprise, is inflation. We are likely to have seen peak inflation in the US, potentially peak inflation in Europe in the first quarter of next year. But potentially going through 2023, it may not fall back as much as expected, and we may get into a period of higher inflation for longer. So my first question to Rosie and also Antoine is, how would this new inflation regime impact the return of the traditional 60-40 portfolio? And for Ulrika, who has more an ESG angle, related ESG investment have also performed quite badly this year. So what I was wondering as well is potentially structurally higher inflation also an headwind for ESG investing? So maybe let's start with Rosie regarding the higher inflation for longer and its impact on 60-40.
Thank you. Well, what an incredible year for the 60-40 portfolio. I think a lot of people who've been running cautious mandates that traditionally had a very high proportion in bonds have had quite a shock in terms of returns. And I don't know anyone who predicted a 30% peak to trough fall in UK gilts this year. An amazing result. So a really fascinating period, certainly looking back over the last 10 years in terms of 60-40, that very high correlation of bonds and equities, and then the significant sell-off that we've seen in fixed income assets this year. For me, though, I don't think it means that the 60-40 portfolio is dead. There's just been a big reset and a reminder in terms of how much money had been made in the bond market. Of course, if you are a person that sits in the camp that inflation is structurally higher, that inflation is staying higher for longer, then you'll certainly have some question marks over the 60-40 portfolio. But if we look at what the bond market is telling us, particularly the TIPS market, the linkers market, the longer end of the bond curve, it is not telling you that inflation is going to be sustained at a much higher level for a very long period of time. So for us, given where bonds yields have moved to, both in terms of government debt and in corporate debt, actually starting to look attractive again, and we're starting to rebuild positions in our bond allocations that have been very low, significantly underweight for recent years. So in terms of the bond side, I don't think that has been destroyed because of the inflation that we've seen this year, with a view that inflation is not a long-term structural issue. And then on the equity side, on the basis that inflation doesn't run above 4 to 5% on a long-term basis, equities are a really important and interesting place to invest in a slightly above average inflationary environment. You have a position where nominal sales continue to rise. Companies have got the ability to put up prices, push through margin improvements. In that type of environment, you want to be invested into certain types of companies, i.e. companies that have pricing power, for example, so they're not suffering from that inflation being seen. But equity is a really nice home to be invested into in a higher than average inflation environment. So for me, 60-40 is not dead because of the inflation that we've seen this year.
Thank you. Antoine?
Yes, thank you, Laurent. And Rosie, I quite agree on that. Basically, if you come back to if you look at the short-term side of things, and consider that inflation will abate at some point, we will consider, like, like in the 70s, there are some period of time where the 60-40 portfolio was the worst case combination you could have, but afterwards, it can recover very quickly. So looking at the short-term side, we could have a relief. So in this sense, of course, 60-40 is definitely not dead. But then, looking at the longer term, and Laurent, you mentioned the structural inflation that might be higher, and I think we have quite some reasons to have this coming to reality, because we have a mix of let's say deglobalization that will put some definitely inflation pressure. Suddenly we have a bit more than ever a bipolar world between the sanctionist and the sanctioned, let's say, and a bipolar world between, because we were used to import cheap goods from China and cheap energy from Russia, and now things are quite changing a bit. Even as well, we have the energy transition that should be quite inflationary. So all this is a good argument for a higher inflation here.
Mm-hmm.
So I did, yeah.
Yeah, go ahead.
So just concluding on that, definitely 60-40 is not dead. And I think it will be more evolving into, let's say, a 60-20-20 portfolio, where you have the regular equities, bonds, and some alternative assets, because in here you need to have a longer term perspective. You need probably some more real assets. Mm-hmm. And yeah, and as you said, I think there is quite a hint for active management, linking to Rosie's remark on the pricing power companies.
Mm-hmm.
That's a really, sorry, I was going to say there's a really interesting point in terms of moving away from the traditional 60-40, and I'm not sure that many institutions have just been running 60-40. As we well know, over the last 20 years, alternatives have played a significant part in terms of that growing strategic allocation, given the correlations with, or tending to be very low, with bonds and equities, and therefore the diversification benefits that those alternatives could bring to and can bring to a portfolio. Mm-hmm. Of course, one has to be careful in terms of what you're investing into, and to make sure that they also have the ability to beat inflation, real assets being a good example of that.
Yeah, I will come back to have your opinion on which good alternative assets, because, for example, at the beginning of the year, Bitcoin and many cryptocurrencies were seen as potentially a defensive assets against inflation, and we have all seen what has happened. But before moving to the point of alternative assets, what is your view on ESG investments and potentially the impact of inflation on ESG investment, Ulrika? Because as I mentioned, I mean, ESG had also a bad year this year. So what is your view here? Is inflation an impact or a headwind?
Yeah, I think that if we look at inflation only, I wouldn't call it a sort of a headwind for ESG investing. But I think that, combining inflation with the energy crisis and the ongoing war, I think puts a spotlight for many investors and asset managers to really kind of revisit their ESG or sustainable investment strategy overall. And because what we are experienced and what has also been mentioned, I won't comment in particular on the 60-40 strategies, but of course we see a much larger appetite now for the alternative space. But I would say that from an sort of sustainability or ESG investing perspective, I think that even though the stock market has priced in a mild recession for next year, but the economy isn't really there. So I think that the most negative, also in relation to what if we call it ESG investing, is probably ahead of us. So I think that I think this is the main focus now to really assess and evaluate the different approaches.
Okay, good. moving on to one of the comments that Antoine made about passive investment against active investment. So now that we are going to be in a macroeconomic environment, which is much more uncertain, do you think that passive, in fact, has seen its heyday over the past few years, and that potentially now we are going back to an era where active managers can outperform and make a difference because you need to be more selective in terms of which companies you're going to invest in, also potentially in the credit market, also some selection may be needed. So do you think also that these massive inflows of money we have seen towards passive is potentially not over, but definitely will slow down and give back the light towards the active? Rosie, Antoine, do you have any view on that? Antoine first.
So I'll start then, Rosie, because you had the first question. I think there is something here and there is a major move in trends because if you look at the last decade, we had quite a lot of easy money and we had huge liquidity. So basically in these kind of markets, you'd better go and buy some indices like everyone else, and even you could risk your money at profitless companies or like concept stocks, But going forward, as you said, Laurent, the environment will be quite challenging. Looking at the macro level, if you think of inflation, for example, it's really tough to predict, especially if you think of Europe, where inflation is mostly driven by the supply side and energy. So it might abate suddenly here. At the company level as well, structurally, we have some concern because now we have higher inflation, higher rates potentially. So higher inflation is quite good for companies on top lines. But at the end of the day, you need to realize what the bottom line is doing in the context as well of higher rates. Basically, you want to be with quality companies. So select the quality companies, you need to make some selections. You need the experience of the fund manager. I think this is one thing as well. And on the debt side as well, some companies were able to finance for almost zero cost money for years and years. And probably now we have some zombies in the closets. And if you have rates that are a bit too high, that they might get out of the closet. So let's say that if you want to go high yield, maybe you'd better do it with an experienced manager, I guess, in this side. And just finally, and I think we have had quite an interesting example regarding cryptocurrencies, thinking of FTX. But now you need to come back to due diligence for real. So it's not just listed markets, it's as well private markets. Rosie.
Just coming back to the point about passives and the role of active managers and the challenges that active managers have had in recent years, it is essential to look at the composition of those passive vehicles. So as we know, if you had lots and lots of tech, you did really well in the 5 years up to 2021. So buying a passive index, buying a tracker on the S&P 500 meant that you already had 25% in your big name stocks, and you probably performed quite well as a result. And particularly if you're a non-dollar investor, had the benefit of having a dollar asset in certain periods when the dollar was strong, a sort of double whammy icing on the cake. And then we look at this year, and energy is the only sector that is in positive territory year to date. So again, if you had an index, so if you had exposure to the FTSE 100, for example, you've done well simply because of the composition of that one sector, that big switch from tech into energy. And I think that's a really difficult environment for active managers who are looking at the fundamentals of businesses in order to be able to outperform. So I think given these big shifts that we've had in the last few years, and perhaps investors starting to come back and think about individual companies they actually want to be exposed to, with also an ESG hat around that as well, the environment for active managers becomes much more interesting, particularly in changing monetary policy environment. But that's not to say you shouldn't use passives. So passives can be really useful in certain parts of the market. We've used a passive vehicle on the European energy sector. Historically, we've used a passive vehicle on the US bank, so we don't have to take that stock-specific risk, but we get quick and easy access to a particular sector where we think there is value. So I would say that passives are still important, and also the use of passives is an active decision. It's really important to remember as well.
Yeah, that's a good point. Potentially moving to this comment about the alternative assets. So if you manage a 60-40, potentially 40% has to be split, 20% equity and into something else. So at this stage, I mean, which alternative assets do you consider as solid, really offering some good opportunities at this point?
The way that we have our or have our alternatives exposure within our portfolios is thinking about transparency, liquidity, and fees. So for us, we think it's really important that in your alternatives element, not only are you buying assets that have low correlation to the equity exposure, low correlation to the bond exposure, and also importantly, low correlation to each other, we also, it's just our investment philosophy, I appreciate there are lots of other styles out there, we also like liquidity, so daily or weekly dealing, third-party funds, for example, and that might be funds that are focused on absolute return, be it in the macro space, be it in merger arb, whatever it might be. We like exposure to real assets, for example, through infrastructure. I think you've got to be a little bit careful as to how you get your exposure through property, particularly with our views around wanting more liquid assets. Gold, commodities obviously have played a role in portfolios too over the years. So when we're thinking about those assets, we think about this correlation point, we think about the liquidity, and then on top of that, we think about fees too, particularly in a MiFID II costs and charges disclosure environment. You suddenly realize actually these funds are very expensive. If they're producing the performance, that's fine. If they're not, it's another story.
Okay. Maybe Ulrika, on the ESG front, do you think that infrastructure fund could be good alternative? I mean, in ESG, I know you will have to be selective in what type of infrastructure fund you look at, but do you think it could be a good alternative?
I think what we see, if I just put my Nordic hat on, we see actually from ranging from the very large institutional investors, pension funds and the likes, their increasing appetite for the alternative space, for the private space, and in particular for infrastructure. So I think that we will we're already seeing and participating in a number of discussions on this type of investment, and I think that there's a growing appetite because of the markets and the search for not only real return but also real impact. So from a sustainability perspective and an ESG strategy, the larger investors are definitely looking into this space, but also smaller investors and smaller institutions. I mean, what we're seeing currently is, of course, that the hedge funds and the institutions have an unusually low proportion of equity in the portfolios now, but retail still has invested more than usual in the stock market. But the question on infrastructure is definitely on the rise.
And it seems it's also because it's delivering on the ESG front, where potentially they have more impact in terms of either carbon emission or solving some of the issues that we have in the real world, rather than being just a financial asset.
Absolutely.
Yeah.
Yes.
Okay, that's interesting. Antoine?
Yeah. Just you said quite a lot already, but coming to two key points, I would say that yes. We believe that diversifiers and uncorrelated solution makes sense, especially if you want to see this 60-40 portfolio evolve. In this area, probably hedge funds are a good way to step in. On our side, we tend to select external manager, single managers when we can, or use some fund of hedge funds, and we aim at uncorrelated solution basically. And definitely, we believe that hedge funds are back. It's like in the movie, Return to the Future. You have some interesting strategy in fixed income arbitrage. Now you have a great playground for these hedge fund managers. As well, you have some global macro players there that are really good, but then you have to be selective and with a huge due diligence. Another thing as well that rang a bell was about real assets. So you mentioned it, and you mentioned as well infrastructure, of course, but because of the inflation we might have in the future, it really makes sense to us. Maybe some contrarian play at some point, because with the market turmoil, this is where comes the rise opportunities as well. If you think of higher rates, and especially in the US, you might see the US housing going down a bit more than that. And at some point, it might make sense to be ready with some, not, let's say, if you can, fantastic, directly buying real assets, but then with some private equity real estate managers that when they will be ready to allocate some dry powder, they will be able to seize the opportunity. But I would say that now it's a bit too early to consider these kind of strategies.
Okay. Antoine and Rosie, very quickly to finish this point. Commodities, I mean, in terms of real assets, do you think it is a good opportunity at this point, or too hot to handle?
Quite a hard decision at this point. I mean, we have had some gold exposure in the portfolio on a dollar basis. It's been a challenging asset to be in this year, given real yields and where they have moved to. In our portfolios, we tend to get exposure to commodities through the companies that we are buying into, rather than going out and buying platinum and zinc and oil, etc.
Okay.
Yeah. Maybe just more than a few words, but gold, I think we have the same thing in portfolios. I believe it's a good hedge regarding inflation, as well in terms of geopolitical crisis. This works well. You mentioned the challenges, Rosie. Commodities, I mean, other than gold, we have quite the same stance that, yes, we believe that some structural imbalance will be needed to be resolved, especially if we talk about energy transition. But in the meantime, we still need some of these commodities and as well some of the fossils. So we play mostly the through companies, especially in the oil and gas sector.
Okay. Okay, so at this point, we have only one question from the audience, which is on the credit market, which I think we are going to address in this coming section, which I would call earnings and valuation. So we're going to focus more on credit market and equity there, and then the final section will be on ESG, where Ulrika will have the opportunity to share our views. So first on the earnings and valuation, the question from the audience is very simply, where do you see fixed income funds in the first quarter of 2023? I think the question is in terms of return or performance. So potentially to attach this question to one I have, which is, what do you think is being priced in today in the credit market? Do you think that peak rates is already priced, or potentially there is still more bad news to come? What is your view overall here on a global basis, not just on Europe?
Big question. Okay, so I'll try this one then. So there are two questions, one about peak rates, the other one is about credit investments.
Yeah, what is being priced in?
I would say. Yeah, so basically, when the question behind is about as well the rate path for central banks, and mainly here there are two main components. One is about growth, the other one is about inflation. So globally, it's not that easy to answer, but if you look by region, you can have a start of an answer. If you think of the US, basically growth is definitely stronger than in Europe. And you have an inflation that is demand driven, basically. So it's kind of normal inflation. Whereas, in Europe, it's a complete different story. Growth is pretty weak, not to say the least. And then we have an inflation shock on the supply side that is huge. And somehow, and to go on the credit side, we will be more comfortable investing into the investment grade space. because anyway, growth is abating. In here, we are even more comfortable in the US, but in Europe as well, we believe that there are some very interesting entry points for the weeks and months to come. So I think that will answer some of the question. Regarding high yield, we are really cautious on this. There are some interesting opportunities there, but we tend to be quite cautious because if you have some growth that is slowing down a bit more, we might see actually these zombies coming out of the closet, and some more spread widening in this section as well.
So on the high yield, would you be more selective towards some specific sectors where you think the fundamentals are safer, or would it be really company specifics?
No, actually, we tend to be we tend to stay quite away from it, and we are not that selective. Basically, we approach it from a diversified way, using funds and ETFs, but mostly funds. Considering the active management approach that's needed here.
So at this point, when you see, for example, European high yield, which is around 9% yield, do you think you are not paid enough for the risk you are taking?
On a selective basis, probably.
I don't know.
But we tend to say that basically, it's like a bit like about equities. High yield basically, if you look at investment grade historically. They are on the historical spreads, so it tends to be quite okay considering where we are going in terms of growth. If you think of high yields, okay, now it's cheaper, it's better than historical, but it can go even wider. So it's more like about the moves that we can see in this market, about the liquidity withdrawal we're going to see as well with central banks, with the quantitative tightening. So yeah.
Okay, thanks. Rosie?
I come at this more in terms of from an equity perspective, but obviously just looking at the bond market, it's telling us we are going into recession. It's a mild recession, though it's an earnings recession rather than a structural recession like we saw in 2008, for example. And when we look at what the market has priced in so far, so multiples broadly, the market have moved, you look at P/E ratio, for example, moved from around 18 times to 14 times this year. So the majority of the movement we've seen down in equity markets has been the P coming down in that multiple compression. And now, of course, there's a big question of where the E is. And we've seen some reset, so an expectation at the beginning of this year of earnings growth being around 7%. That number now looks more like 4 to 5%. So certainly the market has already started to price in some contraction in earnings growth. We don't think we're quite there yet in terms of how much the market is pricing in. So we have to remember, obviously, the market is addicted to monetary policy. So given what the Fed said yesterday, hence why you're seeing such strong moves in markets today and yesterday, even though the Fed has come out and said we're still focused on inflation, it has to be through dealing with the labor market in particular, almost regardless of what happens with equity markets and the rest of the major economies. But they're effectively saying we're getting closer to peak rates, and the market loves that. But we still have to live with the implications of the fact that we've been through one of the fastest tightening cycles in history. Phenomenal moves in terms of the increases we've seen in rates across the world year to date, and we have to live with the consequences of that. So the market is priced in a lot already, particularly in the bond markets. It's priced in a fair amount in the equity market. So peak to trough priced in a fair amount. Actually, it's incredible that markets haven't fallen by more this year, as I say, given the tightening cycle that we have seen. But I think we've probably got a bit further to go before we feel really comfortable with putting lots of money back into equity markets, because we don't think that all of the bad news has been priced in yet.
So just one quick follow-up for you, Rosie. I mean, do you think that we are likely to see an earnings recession next year, or do you think that with inflation, companies should still be able to grow, potentially defend margin, and can deliver despite what is happening in the economy in the real world, potentially falling a little bit? We could still have earnings going up slightly next year. Do you think it could be, I would say, quite unpredictable scenario, but potentially it could happen? What do you think?
Yeah, it's a very good point. I think it'll be very sector specific. So those points we mentioned earlier around pricing power, for example, those companies with defensive earnings profiles operating in niche markets, barriers to entry, subscription revenues that they can genuinely increase. So increase those nominal sales revenues that they are receiving. They're interesting businesses to be invested into. I'm sure we'll certainly see some earnings recession in certain parts of the market. And so really it becomes a much more attractive environment for active managers where you can be a bit more selective in terms of what you do and where you invest. Because even if you look at the tech sector, they're still growing at phenomenal rates, well above inflation. You've still got companies producing some really attractive dividend yields that are being increased every year above inflation, or indeed share buyback programs as well that are really supportive to equities. So I suspect sentiment will swing a lot over the next few months, as I say, driven by monetary policy and potentially geopolitical risk if we start to see some greater concerns there. But it's going to be selective in terms of specific companies that are fine in this environment and can generate that earnings growth, those that just generate nominal sales growth because of inflation, and those that really suffer because they're feeling the impact of what has happened, particularly over the last year as well as the previous 2 years.
Okay, maybe a question for Ulrika. I don't know if it is appropriate or not, but if you look at companies which are ESG driven and really the wind turbine makers, you look at the hydrogen companies. I mean, these companies have really taken a massive hit this year in terms of valuation. I mean, do you think it is because of just what has happened in the interest rate and the equity market space? And so there are high duration companies which will generate their cash in many years or decades, and so that's why they were really punished by the market? Or do you think it's more a reflection that there are some big question marks about, okay, this energy transition, I mean, is going to be really difficult to come through, and so these companies which could look attractive maybe 12, 18 months ago now have much less interest for many portfolio managers? Do you have a view on that?
I think that it's a difficult question in a way, but I think that companies in these sectors and in working with these solutions are, of course, growing in numbers of companies and numbers of solutions. And of course, there will be winners and losers in this space. I think that if we look at, for example, investors' appetite for renewable energy, for wind, for solar, and such investments in order to support the transition to net zero, that same strategy, if you flip the coin when you want to invest into solar, and then you start looking at the solar panels where they are produced and how they are produced, there's a challenge on the supply chain side and issues regarding sustainability matters, such as for some investors with labor standards, with how you actually produce or the raw materials, and also in relation to governance matters. So I think it's a bit of a mixed picture there, but I think that definitely these companies are here to provide solutions for a long time, and I think that there will be winners and losers for sure.
Okay, we have two more questions from the audience. So I think one is definitely for Rosie, which is about which industries and sectors from an equity perspective are you avoiding in funds, and potentially the reverse question, which themes are the most of interest for you at this point? And the second one is more about private against public. We have seen a massive correction in valuation of publicly listed assets. It seems that the correction has been less on the private side, although we had a very interesting news from Tiger funds last week, where I think they took a massive hit to their private equity funds, which I think were mainly technology driven. But yeah, so first question, Rosie, which sectors are you avoiding at this point, and which one are the most interesting? And then potentially the valuation differential between private and public.
So in terms of the way our portfolios are set up and the way that we invest from a philosophical perspective, we naturally have a lower exposure to the banking sector, where we have less visibility, and in a rate rising environment there is concerns that skeletons will come out of the closet.
Okay.
We have a naturally low weighting to pharma and certain parts of the biotech industry, quite challenging in terms of really understanding their pipelines. But overall, we don't say specifically we will not have exposure to a certain sector, because you can still find great companies that are in a certain sector that have very different growth drivers. So for example, if you think about Alphabet, it is listed in communication services sector, has a really different business to some of its peer group. Or Amazon is in consumer discretionary. Obviously there's a consumer element to its business with the interface that we use, but AWS has some very different drivers. So one has to be a little bit careful about just writing off certain sectors, but we have certain sectors that we tend to not be as interested in. Having said that, we are more interested in the industrial sector. So looking at companies that have a level of end market cyclicality. If we start to see the market really pricing in the recession that's likely to come, point mentioned earlier that we don't think we're there quite yet, but those companies that can be early beneficiaries in an economic recovery. And there are some wonderful, really high quality industrial companies, particularly listed in Europe, that have very strong sustainability and ESG credentials as well, and really thinking about the future performance of their businesses with those ideas in mind. So industrials is interesting to us. We haven't written off the tech sector. A lot of those valuations still look really attractive. As I mentioned, the light's just gone out. Been sitting still for too long. Yeah, there are many tech companies who are still growing at phenomenal rates, even in a slowing economic environment and an environment of higher inflation, where multiples have come down this year and are starting to look really interesting versus their 10-year averages.
Okay. Antoine, do you have a list of plus and minus in terms of sectors?
Yes, we do, but I would tend to agree with Rosie, that it's kind of an environment where you need to be quite diversified. We might have some sustained inflation, so we might be keen on relying on some of the value companies and sectors. You know, if you think of, we are quite bullish actually on the energy sector. So this is one of our favorite. But you know, if you consider year-to-date performances, at some point, you know, these kind of companies may suffer from some profit taking. So that might be one thing. On the other hand, you know, some of the growth stocks, and especially if you look into the quality companies and there's robust companies, you know, that can sustain like the future recession or soft data on the economic front, you can start to look at it. It was quite a bloodbath this year, but the end word would be that we should be diversified here.
Okay.
And it's a really good point on, to just add on in terms of valuation. So you look at some sectors like the consumer staples sector, that's been a really good place to hide this year. But the multiples of some of those companies are starting to get unattractive quite. And whilst in the environment they're in, you can understand why investors are chasing those types of businesses that exhibit those characteristics, but I'd be quite careful at this point in the cycle.
Yeah. So to address the question on private, so the question is, there will be pain in private asset returns similar to what has occurred with listed equities, and the pain has just been deferred due to the smoothing of potentially market mark-to-market valuation in private equity. So do you have a view here? Should we see an adjustment in the valuation of the private asset?
I think so. Certainly the environment's changed in terms of the just the economics around private equity, for example. I'm sure there are many transactions within that sector that will need to be repriced quite significantly. To Antoine's point earlier, it's about doing your due diligence. If you've got good assets, you might have a valuation reset, be it public or private markets, but they're good assets for the long term. You carry on holding on to them, but you've got to be careful in terms of the exposure that you've got. And when you saw some of the big private equity houses starting to offer private equity exposure to retail investors at very small ticket sizes for quite illiquid assets, it did send out some warning signals. And then also in sort of the other non-listed asset side, you're obviously seeing concerns about the property market, which we touched on earlier as well.
Okay, that's right. And I think there is one thing about the data points. So as usual, there is a lag between the public and private markets. Maybe you will see a rebound and basically at some point, no down round. But there is one thing as well, if you consider venture capital, is that these companies, they don't really have an interest, in raising capital at a lower valuation because it's not good for them. So there is kind of a lag here. Maybe at some point we will see some of these zombies that maybe need the money the most, that the company that were profitless, having some trouble and some issues. And in this case, the venture capital fund, they have to write down the investment, to write it off. So this is pretty normal. What we see as well, interestingly, is that because some of these companies, one, they have trouble to raise equity because they don't want to face this downward valuation. So what they do, some of them, is that they turn into the debt and private debt components. And of course, because banks are not always willing to lend them money, they need to go to the private debt fund. And here there is some interesting opportunities and actually some pickup offered in terms of yield.
Okay, good. So let's move on to the last section of this discussion, which is going to be focused on ESG. So first question. So first, all the questions are open to all the speakers, but if you think that you are not expert enough, if I could say, to answer the question, you may skip it. So the first one, we all know, greenwashing has been a key topic in 2023, in 2022. So first I was wondering, do you think there is even more to come in terms of greenwashing and what is happening in the industry? And the first question to Ulrika, do you think that it has an impact on the credibility of all these ESG investing?
Good question. I think that if I look at this year, 2022, I think it's a year of a shaking, right? And I think that going into next year will be a year of increased control, where we are seeing, based on the question on greenwashing, sustainability is now moving from voluntary to mandatory, and I think this will not be a walk in the park. And neither for investors, asset managers, or companies, and I think that in the spirit of transparency and better disclosure, we will experience more control and less freedom. And I think that on the greenwashing side, I think data is somehow the new gold, and for those who can make use of it from an investment perspective, will benefit. I think that the data that we need as investors and asset managers, of course needs to be high quality, but it needs to be verified, comparable, and sort of accessible for us. So I think that the whole question of greenwashing, where we are not able to trust the data always, or we're not able to use the data, this is sort of mudding the picture a little bit. And I think that what in the situation we're in now, I think the question that is being asked these days is what will actually make a difference. And I think that the different sort of cases of greenwashing or allegations of greenwashing really puts a spotlight to that concern or question, because I think that investors, asset managers in Europe, in the US, around the world, I don't question the intention, but I challenge always sort of the strategy and the ambition, and really being sincere in your approach. So I think that, you know, this is the situation where everyone has to sort of be sort of almost revisit, go back to the drawing board and consider the strategy.
Yeah, because when you say data is the new gold, I mean, my view was that potentially there are too many data in the market and we don't know exactly which one to use. So what I was wondering is that if potentially one of the solutions, would it be more standardization? I mean, for example, in the technology world, we have seen that when a standard was set up as really the one for the industry, then usually the technology can take off much more easily. While here, some people are using third-party data, some are using their own ESG score. And at the end of the day, we don't know what is what, how to compare even the data set one with the other. So, I mean, also to your comment of potentially we need more control. Do you think it is the solution? In fact, we should have stricter and more regulation? Or should we have just more standard, you're saying using only one set of data so that we all, I would say, dance on the same tune? What do you think is the best approach here?
Yeah, I think the question of standardized ESG data or standardized reporting, and also whether this should be regulated or voluntary. I think this is on the one hand, it's a matter of also different cultures. I think that, again, just sharing a bit of a Nordic investor or corporate culture, we always favor self-regulation, so voluntary, whereas other parts or other countries in Europe are more focused on the regulation. And now, because there's been such a long discussion and debate for many years about the usefulness of sustainability information from companies and about sectors and countries, and because of the volumes of data that is not necessarily creating reliable patterns or that we're maybe not always able to use in order to understand our investments better from many perspectives. I think that what is now coming out from a European perspective with the new requirements on both investors and providers of financial service providers, as well as the requirements on corporates, where sustainability will become law, is really transforming the industry. And on the one hand, I would say that we all welcome a standardized, in a way, standardized way, not on investing with ESG, but a standardized way of accessing meaningful information from companies. So with the regulation now entering into force from next year for companies to report sustainability information covering their whole value chain, and have that reported into their annual reports. Of course, this is driving a standardized way for companies to report. Whether that is investment useful data,
depends.
That can always be discussed.
One question to Rosie and Antoine on the ESG front. I mean, I've done several of the Evenco live event, and some of the comment I've got is that ESG is becoming more and more of an headache either to portfolio managers or to asset allocator. I mean, what is your view here? I mean, is it, I mean, with all these new regulation, all these new data, as I say, which are sometimes very difficult to compare one with the other, I mean, is it for you more and more difficult to do the job here on the ESG front?
You're right. It's a big, complex world. And that's when you look at anything from your own corporate internal CSR policy through to how you deal with companies and their data. As Ulrika said, you get different data depending on potentially what jurisdiction that company is simply listed in, culturally, how much they want to disclose, how important it is to their business. So it is a challenge, because we can't just have a standardized procedure across all of the companies into which we're invested into. A technology company is affected in a very different way to a mining company, for example. So we have to be adaptable. Obviously, you want to have some standardization in terms of metrics you look at, and importantly, to be able to measure what a company said it was going to do and what it's going to do. And on top of which, then you need to take into account the size of the resources of the individual company as well. A small cap company doesn't have the resources that a mega cap company has in terms of the information that they can produce, what they can do internally to their business. So it is a lot of work. What we hope, though, is that this encourages more engagement with us and the companies into which we're invested. We're talking about their strategy, we're talking about challenges they face anyway, and this is another angle. And actually, it can open up some really interesting questions about learning more about a culture of a business, and us just to understand more about how the CEO acts with the rest of the company, how the labor force feels engaged in their work. And if that ends up being a positive in terms of greater productivity for a business, leading to margin growth, leading to earnings growth, that's good news as an investor. But you're right, it's taken up a huge amount of our resource, but it did have to happen. And hopefully it's a good thing for us and all of the planet and the rest of the world if we really harness it and use it in the right way, rather than it just being another burden and a tick boxing exercise.
Yeah, agree. Antoine?
Yeah, and maybe to nuance, the headache is maybe different from one sub-industry to another. So if you run a fund and you want to be, let's say, ESG compliant, you have many restrictions and commitments you need to make. In basically my business is more about private banking. Here, of course, what you can do is rely more on the headache of the others. So basically use the other funds that are quite engaged in this area. I would say as well that we still had some ESG concern, but it was more linked to, let's say, the risks that we want to avoid in portfolios. So it came out relatively naturally, but of course, there is not always a label ESG. But now, you know, regulation is coming as well to the private banking system. And now there are some questionnaires for private clients regarding their sustainability expectations.
Okay. One question from the audience, potentially. What is the best type of ESG data for fund selection? Has any one of you some tips here?
Sorry, what was the best? I didn't hear.
What is the best type of ESG data for fund selection?
I think that with the new regulation or the requirements, the sustainable finance disclosure regulation that is now it came into force last year, and from January next year, all fund managers will need to disclose their strategy, their binding commitments, their approach. So I think for that reason, it will become the transparency from and the reporting from each fund company or fund will be available. Whether that makes it easier for a fund selector or not, that I think is still
debatable.
It's quite difficult actually, because you still need to double click on the fund manager, him or herself, and you need to double click on the strategy and see how it actually connects to the fund manager's approach.
Rosie, do you have which type of data as a portfolio manager you put forward, which potentially could make a difference to better judge your ESG involvement, I would say?
So in terms of how we actually look at it, we look at some of the sustainable development goals. So we've picked some of the goals that we think are most important and most relevant to us. So we look at companies in relation to that. When we talk to funds, third-party funds, naturally they're going to have their own views, but we need to make sure that they are aligned with ours. They might not necessarily be identical. It's a really interesting question. Is there any tools that can screen funds, like you have tools, be it MSCI, Sustainalytics, etc., that you can use for screening companies over their revenue sources, but you don't, that I know of, have a global tool that you can use. But that shows how extensive ESG is. Your ESG is different to my ESG, is different to what my clients want. And I think we have to remember that it's really personal.
Antoine, when you...
nothing much to add, but that it's still work in progress. And I think with some of the major fund selection tool, we are going into the right directions.
Okay, so we have about 3 minutes left. We have already run nearly for the full hour. So one of the last questions, which I think from the audience, which is quite interesting potentially for Antoine or maybe Ulrika, what have been the worst mistakes you have seen from fund manager make in the last 6 months in tackling the current market environment? I've got my answer to that one, but if you have any.
Oh, I guess that basically the obvious one is the double mistakes that a lot of asset managers did, and a lot of one did is about equities and not realizing the impact of higher rates that it might have on the growth sectors, not realizing as well, linking back to Rosie's comment in the first question about the amount we have in some of these sectors in the market. So this is huge. And second, that we didn't realize that there was a big shift, in the interest rate policies and money market easing, and that it gave a lot of trouble to bonds and to the fixed income space.
Okay, Ulrika, do you have an answer?
Oh, biggest mistakes. I'm not sure, but something that comes to mind is when the war broke in February this year, we had quite a number of fund managers and investors who sort of just flipped the coin on the arms industry. And I'm not saying that is a mistake, but that was actually quite a challenging debate. What is the strategy? From divesting or investing, and it went both ways actually. So I think that again put a spotlight on the importance of being founded in either your values or your value, financial value versus my values. Yeah,
Rosie.
Some of the biggest mistakes you've seen this year is around the crypto space. I can understand why people held crypto in their portfolios. I can understand why they had exposure to some of the exchanges, the big players in that. For us, it's not an asset class that we have exposure to within our portfolios, but obviously that's been a really challenging investment for a lot of people this year.
I think for me, one of the answers would have been style drift. I mean, I know that we are living in a very difficult and different market environment, but if you have a style and people selected your fund for the style of investment, if you decide just because of what is happening, you have to change I would say either from value to growth or vice versa, then definitely it's always one of the mistakes that one portfolio manager can make. Thank you very much. We have run through the hour. Thank you all to you for your insights, and I hope the audience enjoy the discussion, and hopefully we'll see you for the next Trend Watch in 2023. Thank you. Have a nice evening. Bye.